Several of you have been asking the same question in the comments. Is silver finally starting to behave differently? Is something changing underneath the surface? Today we are going to answer that honestly, not with a price target, not with a promise, with the actual evidence on the table right now. This is GoFinance. Let me start with what happened Friday, March 27th, because it is worth paying attention to. Gold jumped hard. Silver moved up strongly. Stocks got hit. The S&P 500 fell about 1.7%, and the Nasdaq dropped about 2%. Spot gold was near $4,500. Spot silver near $70, and the 20-year Treasury yield stayed elevated near 5% instead of collapsing. One day does not prove a permanent decoupling. Let me be clear about that. One strong session does not mean gold and silver are forever free from the stock market or the bond market, but it does matter. When metals rise on a day when broad equities are weak and borrowing costs are still high, that gets attention. Not because it proves everything, because it hints that something underneath the surface may be changing. Here is what most people forget about how these episodes work. In stressful periods, gold and silver do not always act heroic on day one. Very often the first move is ugly. They get sold. Why? Because people need cash. They do not sell the thing they hate. They sell the thing they can sell. They sell what is liquid. They sell what has a bid. They sell what has a profit in it. That is how forced selling works. So when metals dip during panic, that does not automatically kill the thesis. Sometimes it tells you the market is in the part of the process where investors are scrambling for liquidity before they start looking for safety again. We saw versions of that before. In the early pandemic shock, silver got crushed first and then snapped back violently. In the credit stress of the late 2000s, metals took a hit and then became part of the answer as faith in paper assets weakened. The pattern is not always identical, but the rhythm is familiar. Forced selling first, repricing later. So what is the actual setup right now? Here is what I think is more important than any price target. Silver may be moving away from the pure industrial-only story and back toward a blended identity, where it is being seen simultaneously as an industrial input, a hard asset, a crisis hedge, and maybe even a form of money in the minds of more investors than people realize. Everybody talks about electronics. Everybody talks about solar. Everybody talks about electric vehicles and data centers. And yes, those things matter enormously. Silver is useful in the real world in a way most metals are not. It shows up in modern systems because it is extremely conductive, durable in key applications, and very hard to replace cleanly in certain high-performance uses. But if you think silver is only an industrial story, you are missing the bigger engine. Industrial demand can support a market. Monetary demand can change the personality of a market. And we may be getting closer to that discussion again. Could silver move significantly higher from here? Yes. Could it reach ranges that today sound exaggerated to most people? That is possible, but the path matters. If silver is going to do something dramatic, it will not happen in a straight line. It will not happen because everybody suddenly agrees. Usually the biggest moves happen when the majority still has one foot out the door. That is why these markets feel frustrating before they feel obvious. You get a rally, then a shakeout. You get a breakout attempt, then a scare. You get a strong week, then some macro headline knocks it around again. Technically, what bulls want to see is not just excitement. They want repeated evidence that sellers are losing control at higher lows, that each attempt to push price back down is doing less damage than the one before it. They want to see a market that absorbs pressure instead of collapsing under it. That is how bases are built. Now let me give you the nuanced picture that the loudest silver bulls often skip. This year, the silver market is still expected to run a physical deficit for a sixth straight year. Supply is rising only modestly. But industrial fabrication is also expected to ease from last year's record level because solar manufacturers keep using less silver per unit and looking for substitutions where they can. At the same time, physical investment demand is projected to rebound strongly, so the story is bullish. But it is not a straight line where every category only goes up forever. That is important. A mature bull case is always stronger than a cartoon bull case. If you need every single variable to be perfect, your thesis is fragile. If your thesis still stands even after you admit where the weaknesses are, now you are talking like an investor instead of a cheerleader. One of the weaknesses people need to admit is this. If silver is partly rising because the world is getting more unstable, that is not a clean, happy, easy backdrop. It is messy. It means volatility. It means sudden air pockets. It means violent reversals. It means people getting shaken out right before the move they were waiting for. Now let us move into the part of the story that is much more interesting than internet price targets. Governments are making moves around metals. Not everybody is secretly returning to a gold standard next week. I'm not saying that. I am saying the way states, regulators, exchanges, funds, and investors are starting to treat precious metals looks more serious than it did a few years ago. Russia is one example. Russia will restrict exports of refined gold bars above a certain size starting May 1st. The exact motivations can be debated. People go too far when they instantly turn every Russian decree into proof of some giant hidden monetary reset. But even if you strip away the drama, it still tells you something simple. Gold is strategic enough that governments care about where it goes, how it moves, and who controls it. That matters. Then there is India. And this is where the story gets more interesting for both gold and silver. India's regulator announced that starting April 1st, mutual funds valuing physical gold and silver will use domestic exchange-based spot prices tied to physically delivered contracts instead of the older London benchmark approach. That does not mean the entire global pricing system just broke overnight, but it does tell you that a major market wants local pricing mechanisms to matter more. That is not nothing. Another part of the India story is how silver is being treated inside lending rules. The Reserve Bank of India has consolidated formal directions on lending against gold and silver collateral. The framework includes handling, valuation, storage, release, and auction standards for pledged silver as well as gold. In plain language, silver is not being treated like some random trinket. It is being treated more explicitly as recognized collateral in a structured financial system. That does not mean every household in India wakes up tomorrow and starts leveraging silver bars for easy money. People exaggerate these things, but symbolically and over time practically, it matters when silver becomes easier to treat like an asset you can borrow against, instead of an asset you must sell to unlock value. That is how a metal starts behaving more like money. India also revamped mutual fund rules in a way that opens additional room for gold and silver exposure inside certain portfolios. I am less interested in the exact headline number than I am in the direction. The direction is simple. A major investment market is creating more pathways, not fewer, for precious metals exposure. That is a structural tailwind. Maybe not tomorrow morning, but structurally, yes. Then there's China. People talk about China as if demand over there is always exploding in the same direction all the time. That is not true. The reality is more mixed. China's overall gold consumption slipped last year, but purchases of bars and coins rose sharply and overtook jewelry demand for the first time. That tells you something very important. Even when total consumption softens, the composition of demand can shift toward investment and safe haven behavior. When jewelry softens because prices are high, that does not automatically mean interest in precious metals is disappearing. Sometimes it means the market is moving from adornment to protection. And that shift matters. Now there is something else catching attention. UBS suspended withdrawals from its Euroinvest real estate fund for up to 3 years because liquid assets were not enough to meet redemption requests. Other managers have already put limits on withdrawals in private credit vehicles. Does that automatically mean another 2008 style collapse is here? No. That leap is too dramatic for the evidence we have. But it does mean pockets of illiquidity are not theoretical anymore. They are showing up in the real world. And once investors start seeing gates, caps, delays, or redemption friction in one part of finance, they begin asking a different question. Not just what yields more, but what can I actually get to when I want it? That is a very different mindset. That is when possession matters more. That is when collateral quality matters more. That is when counterparty risk matters more. And that is one reason precious metals start to look attractive again, especially to people who have lived through enough cycles to know that quoted value and realized access are not always the same thing. This is why silver's identity is so important right now. If silver were only an industrial metal, you could build a bullish story around technology growth, electrification, power systems, and energy transition themes. And that story would be fine. But the reason silver can become explosive is because it can catch demand from two very different directions at once. It can be wanted because factories need it. And it can be wanted because people need something outside the usual paper promises. That is the unique part. That is why silver can behave in such a frustrating way for long stretches, and then suddenly move in a way that feels almost unfair to anyone who waited for perfect confirmation. Last year's industrial silver use hit a record of approximately 680 million ounces. And even though this year is expected to cool a bit because of thriftier solar manufacturing, the latest outlook still expects supportive demand from data centers, artificial intelligence-linked technologies, and automotive applications. So the broad structural case did not disappear. It just got more nuanced. But even with all of that, the monetary side is the bigger story. For most of history, people did not need to be talked into the idea that silver had monetary value. They assumed it. The modern mind has forgotten that because we grew up in a world where paper and digital claims are treated as default reality. But gold and silver did not become valuable because some analyst discovered them. They became valuable because societies across time kept returning to them when trust broke, when paper failed, when rulers overpromised, or when the public wanted a store of value they did not have to explain. Gold has already been reintroduced mentally as a serious reserve asset in many parts of the world. Central banks have been acting like that for years now. Silver has not been fully reintroduced in the same way yet, and that is exactly why it is interesting. Because if gold is already accepted as the serious asset, silver is still in the stage where half the market treats it like a joke until it starts moving too fast to ignore. First dismissal, then irritation, then disbelief, then panic buying. I'm not saying that exact sequence must happen tomorrow. I am saying that is the emotional roadmap these markets often travel. What should you actually watch? Watch behavior, not slogans. If metals keep holding up better during equity weakness, that matters. If metals keep finding buyers even while yields stay uncomfortable, that matters. If every pullback starts looking shallower and every rebound starts looking faster, that matters. Watch policy and market plumbing. Changes in pricing, collateral treatment, fund access, and export control all tell you how seriously important institutions are starting to treat these assets. Watch physical investment demand. The latest outlook expects physical silver investment to rise strongly this year, and that is a very different kind of support from speculative futures churn. It speaks to ownership, not just trading. And watch the broader financial system for friction. Redemption gates, funding pressure, rising yields, stubborn inflation. All of that matters because silver rarely makes its most interesting moves in a world where everything else feels perfectly fine. You do not have to root for chaos to be bullish on silver. A lot of people in this space talk as if the best possible outcome is for the system to blow up overnight. That mindset is unhealthy. If you get a true market breakdown, you also get confusion, policy responses, trading disruptions, possible windfall rules, tax surprises, and friction. People never think through. What you want as a metals investor is a steady repricing, one in which silver and gold gain recognition, paper claims get questioned, real assets get valued more honestly, and the market still functions well enough for you to make decisions in a normal world. That is the healthier outcome. That is the outcome worth preparing for. The stage we are in right now is where the evidence is building, but the conclusion still feels too big for most people to say out loud. The stage where the market gives you just enough confirmation to get interested and just enough volatility to make you doubt yourself. The stage where narratives begin to shift before consensus fully catches up. Markets telegraph big changes before headlines catch up, before consensus feels comfortable. Keep your eyes on the behavior. Keep your eyes on the policy shifts. Keep your eyes on the physical market. Keep your eyes on the cracks in the financial system. And most of all, keep your eyes on silver's identity, because if the world starts treating it less like an afterthought and more like an asset that sits between industry and money, the move ahead could be far more powerful than most models are prepared for. We are stackers here. We understand that the biggest moves rarely feel obvious before they start. Drop a comment below. Where are you watching from? And do you think silver's industrial demand or its monetary role matters more from here? I read every comment, and I will pin the best analysis. If you want this analysis in your inbox every morning before markets open, join the Go Finance newsletter. Every day before the session starts, you get a direct summary of what is moving gold and silver, what the data says, and what to watch. No noise, no headlines. Just the information that matters before anyone else has it. Link is in the description and in the first comment below. Subscribe. Turn on notifications. Data before price. Go Finance.